Hey guys, it's Spencer Hakimian. As you can maybe tell, we're in a different location today. I'm away out of town for a few days, so we made a little makeshift studio. I brought all my equipment because I don't want to leave you guys hanging at all. And I'm glad I did because we have a very busy episode today. We're going to be talking about the 15% tariff rate on Japan, the potential 15% tariff rate on Europe, what this means for the American economy, the European economy, and the Japanese economy, and if there is some incoherency in this policy and how we can fix it. So stay tuned, sit back tight, and I hope you enjoy. And welcome back to another episode of What's Moving Your Money on Forbes. So late last night, we got notice that United States and Japan agreed to a roughly 15% tariff on all Japanese exports into the United States. And the instant market reaction was rather fascinating. It led to a major spike in the Nikkei, which is the Japanese stock index, and a major rally in the yen. And at the same time, it basically led to a flattening and even a little slight decline in the S&P 500 and in the dollar. Now that might seem a little bit counterintuitive when you think about it just on its premise. Why would the country that its exports got more expensive actually be performing better than the country who is in theory going to be receiving the tariff revenue? And it's all about the totality of the package we're dealing with. In economics, you can never look at something single dimensionally. You must look at everything. Everything is a package. There's not one thing, there's moving parts. And when you combine these moving parts, the compilation of all of them is a rather strange mix of policies that the United States, as it currently stands, and as we all know, these tariffs change every 3 minutes, but as it currently stands, is a little bit peculiar and somewhat contradictory. So we are placing a 15% tariff on Japan. And let's just use the auto sector as an example because it really shows the strangeness, the incoherency, the peculiarity of what we are doing. So we put a 15% tariff on all exports to the United States that are coming from, let's call it Toyota. Yes, they do make a lot of it in the United States, but let's also just talk about the stuff that's coming from overseas, right? From Tokyo. At the same time, we have placed a 50% steel tariff, a 50% copper tariff, a 50% aluminum tariff, a 25% Canadian tariff, a 25% Mexican tariff, and a 55% Chinese tariff on any and all imports that GM or Ford choose to get. And as you guys all know, all of their supply chains are based over there. It is even production that's done in the United States is so heavily dependent on overseas supply chains that a lot of the composition of the actual thing is, for all intents and purposes, an overseas product. So we are literally charging a higher rate to GM and to Ford to produce a car in the United States by virtue of all those input tariffs than we are charging Toyota just to send something from Tokyo into California, as an example. So it's obvious when you see it. You see a market reaction where GM is flat / down 1% and Toyota is down 12%. You can never trick the market. The market is the sharpest and most intelligent pricing tool on earth. It is the compilation of all of our opinions. It has everyone in there, and it's people with skin in the game. It's not just pundits on TV. These are people that are risking their money making these decisions. The market quickly spotted out that what the heck, this is actually a better trade deal for the Japanese than it is for the United States, particularly the autos. You don't believe me? Well, look at this. Right as the tariff rate came out, the lobbyist group for the big three automakers in the United States came out in Detroit, Michigan, and said that they oppose this deal. Why do they oppose this deal? Because they see the same thing that I'm explaining to you in this podcast. They are on the front lines. They know how expensive cars would get with a 50% steel tariff. They know that Japan just got a freebie when not having to pay that any longer. So that explains the market reaction. I thought it was fascinating. Let me know in my comments. Do you agree with me? Do you not agree with me? Do you think my take on Japan is right or wrong? Do you think the market mispriced this? I want to hear from all of you, so please don't be shy. Next, let's talk about Europe, because we today got a preliminary announcement, some might call it a leak, that Europe is also agreeing to a 15% tariff with the United States in a very similar capacity to the deal that Japan accepted. Now again, this again is a little bit strange because, as an example, Germany is one of the biggest heavy machinery exporters on earth. What is in heavy machinery? It's steel, it's aluminum, it's copper. It is all these input costs that we've now artificially made more expensive for American factories, for American businesses, for American smelters, for whatever you want to think about it. So again, why would we put a 50% tariff on ourselves and then only put a 15% tariff on the Germans? It's just inconsistent, right? I don't agree with the tariff ideology at all. But this specifically is really peculiar, and it's, again, validated by the market pricing. Every time a tariff gets announced, the country that agreed to the tariff, they're seeing their stock market, their bond market, their currency market rally. We're just seeing flat behavior over here, which is, I guess, kind of strange, but I guess it is somewhat validated by all of these things. Now, another thing that I noticed in all of these trade talks that I thought was very interesting was, if you guys remember, back in February, March, April, when these trade talks were just beginning, remember we were talking we as in the United States was talking about how it's unfair how other countries have allowed their currency to depreciate so substantially against the dollar. We even went as far as calling Japan currency manipulators, and that's a loaded term, by the way. We really only used that for China in the past in terms of major countries, major economies. We didn't get any concession on currencies in any of these trade deals that were announced so far. I thought that was very interesting because if any of the stuff that President Trump is doing actually has some history, some merit, some precedent to it, it was the currency aspect of what he was talking about. Beyond that, if you guys remember the Plaza Accord, right? That was in the 1980s when the dollar got too strong and we came with all the other countries in the G7 and we agreed to weaken the dollar and strengthen the other currencies so as to make American exports more competitive, which in theory is the goal. But beyond that, Trump chose Scott Bessent as his Treasury Secretary. Scott Bessent was famous for working for George Soros, who still probably is the best currency trader of the 20th and probably even the 21st century as of now. They, together with Stanley Druckenmiller and Scott Bessent and George Soros, put on the most famous trade maybe in market history, where they broke the pound. They shorted the pound and caused its peg to break. So a lot of the Wall Street thought was that bringing in Scott Bessent, they were really going to go after all of these currency practices. The yen has fallen 40% versus the dollar in the past couple of years. The euro before January, it's since weakened. The euro has since strengthened, but the euro is down almost 35% versus the dollar since just a few years back. So we really thought they would come in and go for these things, right? Particularly because these are things that would help the United States export capacity. It would make American exports cheaper. It doesn't come without risk because we would be importing inflation with a weaker currency, but we thought they'd be going after this. But I just noticed they didn't mention any of it, and it was kind of strange to me. Maybe they tried it and it didn't work. Maybe the countries weren't willing to budge. Who knows what it was? I'm sure someday down the road there's going to be books written about all these negotiations, and they'll be fascinating. Now, one final thing here before I let you guys go. I think what we're seeing is President Trump is beginning to realize that if he keeps pushing these deadlines back, if he keeps going past these deadlines without announcing any type of deal, right, he is going to lose credibility. So in the interim, I think what he's doing is he's announcing deals that are really rather similar, I should say, to the deals that he announced back on, not the deals, but the tariff rates he announced back on Liberation Day on April 2nd. As an example, Europe at a 15% rate is not all that much different from the 20% rate that it was originally getting charged. The Philippines at a 19% rate is not all that different from the 20% rate it was originally going to be charged. I think he's realizing he has to come just with some headline of a deal so as to take off some of the pressure of that taco nickname. The market is all about optics. Reputation is all about stereotypes. If you get a reputation as someone or something that doesn't go through, it's very hard to break that. So I think that's what we're seeing here. But again, I want to hear what you guys have to say in the comments. You can see this show on Forbes' YouTube page, What's Moving Your Money with Spencer Hakimian. You can also see it on Forbes' website. You can see it on my Twitter page. And you can see short little reels of this on my Instagram page and my TikTok page. So I hope you guys had a good time, and I can't wait to see you guys again tomorrow for our next episode.